Hello and welcome to Jim Dalton's presentation for preparation for Monday, April 20th, 2015. It's fabulous to see you all here. Happy Monday to you. Thank you for taking time out for this pretty on-point presentation. This is going to be brief, but it'll be action-packed and information-packed. Right now, I'm just finishing the morning report PDF, so it's going to be posted at our site at the upcoming webinars. The evening recap and preparation report is already there. It was just posted a few moments ago, so please grab that, and that'll help with this presentation. And I'll be sending an email with both reports in them to you, so you can get it by email or you can get it at our site. I'm just about at the posting the report at our site. So for the morning report, the evening report is there. Okay, and with that, thank you for that. Sorry I'm a little behind on that, but we'll have it in just a few minutes. And I'll take this moment to introduce Jim Dalton. Good morning, Jim.
Well, good morning. For those that are going to be in the intensive, once the intensive starts, we do every Monday morning. We do this same type of preparation for the week. The first thing that I want to do is everybody, when you get a day like Friday that goes down as sharply as it did, we are inundated with questions of people saying, is this the big one? Is this the start of, the leg to the downside? Was this long-term money? Or some of them say this was clearly long-term money selling in the market on Friday. And I want to address that first because that is really very important. When you take a look right down, I'll make this a little larger, you have 5 clustered highs at right around the 2078 level. There's 1, 2, 3, 4, 5 clustered highs in the morning. Then the market broke late in the afternoon, returning almost to those clustered highs later in the day. What you find when a market goes down like this, and you started about 3 or 4 in the morning, and the market started down, gapped lower, and continued down throughout the day. One, when you get, don't forget you have the gap above this and then all these single prints. Generally, when you see that many single prints, it is an indication that you are looking at liquidation, not a combination of liquidation and new money selling. Now, you never know for sure. Anything can happen. Secondly, when you see the clustered highs right around here, that supports my argument that more than likely we were looking at liquidation, or remember, another word for liquidation is old business. And what people are always, the real question from a trading standpoint, am I looking at old business or am I looking at new business? New business has much larger odds of having continuation, in this case downside continuation. Old business has greatly reduced odds of downside continuation. When we got the clustered highs around the 2078 level, that to me is very supportive that I was looking at only liquidation. Once the liquidation started, then you get short-term trading money. And if you had any real long-term or new money selling, it is highly unlikely that you would trade so exacting around the same high for 5 periods. Highly unlikely. That is a sign, when it's that exacting, that is a sign that I have, or we are looking at short-term emotional trading money. And it is the short-term emotional trading money that gets us in trouble many times. So the market, late in the afternoon, we had the FGH 3-period balance. For those of you that are familiar with what we do, we have what we call a signature trade worksheet. one of the signature trades that we're always looking at is a breakout from balance. Balance and excess are the two most important concepts we ever deal with. Balance, we can talk about a breakout from balance on the long term, or we can talk a breakout from balance on the short term. They are both the same trades. They just kind of represent different time frames. When you have a 3-period balance, FGH, that breakout from balance is generally a go with trade. So it's short-term money, it balanced for 5 periods, 2.5 hours. Late in the afternoon, the short-term traders really started to push this market to the downside. When you have, by that time, you were already 1, 2, 3, 4, 5, 6, 7, you were already 8 wide at this level. That level would have been at the 2075, 25 level. When you have the point of control that wide already, it takes a tremendous amount of volume in order to stay below it. That doesn't mean that you don't get this emotional selling. So this was a short-term trade. Take the trade coming out of balance, but the odds were that it was short-term trading money, and that's exactly what it did. And it set up just a huge trap. And the market came back, settled within that initial balance as the market closed. This was, it was scary to watch it go down, but the odds were very slim that it was going to be lasting. The odds were much higher that they were just setting up a very big trap. Now, one of the other things that was going on Friday, you had month-end options expiration. See, recently, about 70% of the time on the month-end option expiration, the market has been weak throughout at least the noon period. I don't know what's going on there, but I'm guessing that somebody is playing some games or knowing that they can pressure those people. When the market started down overnight, from someplace up around the center of Thursday's range, and we were gapping lower, they already had the option traders in trouble. Most option traders sell premium, and if you know me very well, you know that I believe that selling premium is probably the riskiest business that exists in any market. Traders love to sell premium, and then of course their dream is that the market's going to do nothing on expiration, and they'll just bank all that premium. When the market starts down and they've sold for nickels and dimes, they have to cover that premium or back in $1, $5, and $10 bills. And I think that's what happened again on Friday. So you had a market that was already overly long. Let me back up for a little bit. Some will say, well, you had no excess up here. But if you think about trade location, and we'll take a look here for a second. Trade location coming into last Friday was at the high, almost at the all-time high. The all-time profile high is 2109. From a trade location standpoint, we came into Friday, or we closed Thursday night at almost the all-time highs. Some people will say, but Jim, we had poor highs both on Wednesday and Thursday, and the answer to that is yes. But remember, we also had a poor high, or poor low from Thursday. So trade location was very important. You had a very high risk level from trade location. The market, if you take a look, you had a very prominent point of control down in at the 2088 level. You had another prominent point of control up here on Friday. So you had two prominent points of control that had not been revisited. This is from Thursday. Also, remember, Thursday's attempted direction was up. Value was overlapping to lower, and you had a poor low. Value is the most important thing that we consider in the marketplace. So Thursday was a weak day. The market attempted to go higher. value was overlapping to lower. I got some emails from people that get, they follow too much on price, and they were very positive going into Friday. And I said, I don't know why you'd be positive, because you did have lower value. Now, I understand that you didn't have any excess or completion to the long-term highs. You had two back-to-back poor lows, but you had two very prominent points of control. With the market closing above it, you had lower value. So the market was very long, and more than likely, the condition that existed coming into Friday was that the short-term laggard traders had just gotten too long. You got the liquidation on Friday, and as I said, and the report that you'll see, I wrote Saturday. I said I did not believe that this was serious selling coming into Friday. I thought it was liquidation, and the evidence was that we didn't have the elongation, had all the clusters, the cluster highs right around here. Additionally, you will see that report said that there would be stops right above the clusters. If you take a look, the overnight low was 2078.50. The high of the clusters was 2078. Now, the first important point for this morning is that not all stops are placed in the overnight market. An awful lot of daytime frame traders do not place their stops in the overnight market. So we have the potential for more short covering this morning once the market opens. Coming into this morning, overnight inventory is 100% long. The settle is at 2075.50. 100% of the overnight trade is to the upside. We know that about 65% or so of the time we get a counter auction to overnight inventory. When we don't get the counter auction, that is usually, in this case, if we don't get a counter auction or a strong counter auction to the downside, that is generally positive. Friday, the market was short inventory. We did not get a counter auction. That was negative. So there's information in what happens relative to overnight inventory. So coming into this morning, overnight inventory is 100% long. The odds are that we get a counter auction to overnight inventory. If we don't get a counter auction to overnight inventory, or it doesn't at least get down into the value area, top of the value area, then we're looking at probably a fairly positive day. If the day is going to be weak, more than likely we will have a counter auction to overnight inventory. We will get down below the cluster levels, and we will start to trade down below the settle. Unless we trade below the point of control, which is basically where the tick apart of the settle, unless we trade down below and find acceptance below 2075.50, value will be at least overlapping to higher today. Okay, so net, what am I looking at today? The top of the gap is a reference. Do we find acceptance above the top of the gap? If we find acceptance above the top of the gap, that is fairly positive. Once we find
the bottom of the gap, excuse me.
I'm sorry, the bottom of the gap. Thank you. If we find acceptance above the bottom of the gap, that is fairly positive because it's going to be very difficult to get even unchanged value for today. If we start to find acceptance back down below the top of the value area, then we start to focus on the point of control or the settle. To get anything really negative, we're going to need to get down below the point of control today. So net coming in, we open here in just a few minutes. Coming into today, overnight inventory is long. The odds favor a correction. If we don't get that correction, that is positive for the market, at least on a short-term basis. What would be negative is to correct all of the overnight inventory, trade below the overnight low, and trade down and below the prominent point of control from Friday. Now I'm going to switch very quickly over to another market. I'm going to look at crude oil. Crude oil is now open, but very quickly, we had an excess low on crude oil. Then the market balanced. We broke out of that area, but this area, the breakout here, overlapped this, which is an indication that the recovery rally in crude was not particularly strong. The lower trading range, then the next trading range was slightly above it. This was healthy. This was a fairly healthy indication that the market was trading higher, would trade higher and show continuation. The fact that this 5-day balance or 6-day balance, whatever you want to call it, overlapped this is an indication that the crude is in more of a short covering rally and less of a stronger recovery. Doesn't mean it's over. It's just an indication it's not as strong as price would make you believe. We then got on Thursday and Friday, we had a 2-day balance with Friday being an inside day. So we have what we call balance within balance. Friday was an inside day. The trading reference this morning would be the low of the 2-day low at 56.60. So if there's anything meaningful on the downside in crude today or early this week, you would start to trade down below the 2-day balance at the I got to get the go-to-meeting thing out of the way here, at the 56.60 level. So in our parlance, right now, balanced trading rules are in effect for crude. The balanced trading rules are remain in balance, remain within the 2-day balance, which is right now. If you remain within the 2-day balance, and you're at the lower end, the destination trade becomes the upper end of that balance. Second, that's the first rule of balance. Second rule of balance, if you trade below balance and fail and come back in, then the destination trade becomes the upper extreme of the balance again. Third rule, if you trade below balance and accelerate lower, that is very negative. So our reference for crude to start the day and the week is 56.60. That's just a very fast rundown on that.
Quick question, Jim. May I
Sure.
crude? We got an inside bar from Friday. We opened below it. Looks like a small gap, and now we're trading back inside the balance, the inside bar range. If you're in a trade now, because obviously there's an overnight inventory correction, or I'm thinking it's probably playing out like that, would you say the scenario right now, at least very near term, is to try and trade to the top of the inside bar?
I would not. My focus, and I may be wrong, my focus is on the 2-day low at the 56.60 level.
Okay.
That's what I see, and it doesn't mean I'm right. It may vary up. The low on Friday was 56.85. The low this morning 56.79. 6 cents difference. It's like I say, my real focus is if we don't trade below the 2-day balance, then we have a good chance to rotate back towards the high. But if you get long when you re-enter Friday's range, you want to stay above that Friday low.
At 56.85.
Yeah.
Yeah. Okay.
I took a fast look at gold, and what I saw when I looked at gold was these 3 lows that are very close together. Those have been with us for a period of time. Understand, we talk a lot about the potential for what we call a firecracker effect. The firecracker effect is just when you have lows that are very close together. You take out one low, that many times will trigger the next low, etc.
Because
that's
they're
what
so close in the stop.
they're so close together. One set of stops triggers another set of stops, triggers another set of stops, and it usually occurs when the lows are relatively close together and the ranges are fairly tight. So what do we have on gold today? We have gapped lower, and I didn't know when I was prepared to talk to you about gold, I had no idea what was going to happen. It's just what I looked at this weekend to get prepared for this morning. I saw this potential of the firecracker effect. So now you have gapped lower this morning, and the gap trading rules are in effect. Gap trading rules go with all gaps that aren't filled immediately or very quickly. So now you've taken out one low, you've taken out 2 lows, your first reference is going to be the Thursday low, which is at again, I have to move to go to meeting.
It's a little speed bump there right now.
Yeah, it's 1194.30 and 1193.60. So as Julia said, it's a speed bump. That's where the short-term reference is, right at the 2-day low right now. So right now it looks fairly negative on gold, etc. Okay, I want to go back. I want to go back to the S&Ps, and we've got about 8 minutes before we open. A couple of questions, Julia. I talked awfully quickly, but we had a lot to cover.
Yes. With regard to the crude, someone's asking what are the odds of each scenario actually, with crude, given?
I don't know. I didn't go to that detail.
Yeah.
I didn't go. What I tried to do. I mean, our basic focus in our teaching is on the S&Ps, but I know we do have a lot of crude traders and we do have a lot of gold traders. So I wanted to do a fast recap on crude and gold as we started the week. But I didn't dig into detail looking at the past. When I go into detail and look at the odds, I go into the past profiles and I look very closely at points of control, volume, etc. I just want to do a fast overview. Okay.
How about
now,
this, Jim? Go ahead. You back at the S&Ps. Speak. I'm sorry. I'll ask after.
No. Okay. All I was going to say is, let me just show you what we do when we get ready to prepare for a day like today. Now, first of all, we take a look at the daily bar, and the daily bar, I don't know if this is 34, 35, or 36 day. I may have counted wrong. But I look, and the first thing I look at is for the last 35 trading sessions, we have gone absolutely nowhere in the S&Ps. It's just been a lot of very short-term volatility, big day, big difference, with no real direction. So there's nothing that tells me that volatility is going away. But remember, there's no indication of long-term money on either the buy or the sell side of that market. And that's where people get themselves in a lot of trouble, is they always want to see more than is really in the market. When I look at this, there's never been any completion to the long-term auction. Now, we did have a gap on Friday, and that gap is still there this morning. A gap can serve as a substitute for no excess on the high. I've seen this happen before with the S&Ps. Usually when you get a gap and the gap serves as excess, then that tells you you're in a liquidating break. Now, I've seen the liquidating breaks run up to 15%. But once the liquidation is over, the market generally comes back through this gap and through the old-time highs. So usually, if you get a good excess on the high, sometimes it can last for years. Usually, if your excess takes place as a gap, it is usually very short-lived, maybe short-lived, maybe a couple of months or so, maybe a little bit longer, but it's usually a liquidation break rather than a sign of really new, strong selling. Sometimes you'll get the liquidation because the market just gets too long to go any higher. What that means is too many weak hands keep buying, trying to get the high, so every time the market goes up to take the high, the weak hands start to take some profit. So sometimes you need to clear that out, and for multiple time frames. So that's where I start. I look and I say, there's nothing really going on in this market. The Friday settle was about 9 handles above the center of this 35-day trading range. So again, we don't really have anything going on in this market with just a lot of volatility. That's what I just covered. We covered this earlier. Selling at the 30-minute highs. That is more than likely short-term money, and it is unlikely that remember, this was written before today. It was unlikely this would last. This was written over the weekend, so you see we're well above that today. Remember, this reference at the 2078 level, which is the high of the cluster, that remains a reference this morning. We've looked at this. The different scenarios this morning are really, they've changed a little bit based on what the market has done. But the different scenarios this morning are that we would have had the gap and we would have gone straight lower this morning. We didn't do that. So that scenario is off the table. Second scenario was that we look above the high, at the cluster high at 2078 and hit some stops. Well, we did part of that overnight. So the cluster high now becomes a support area, so to speak, for a short-term trade this morning. And we're going to open here very shortly. So this is where the stops were hit. This will become short-term support. Unless we get down below the 2078 level, the market's going to be fairly positive today. In other words, we will get higher value. We also have the top of the gap at the 2087 level. If we get acceptance during the day time frame session at the top of the gap, of course, then we're watching to see can the gap be filled by trading up to the 2092 level. Okay, so we're getting a little correction of overnight inventory as we come up to the open. We got 2 minutes, a couple of fast questions, Julia.
Jim, quickly before the open, can you collapse that profile by clicking cancel? And you also have an overnight profile up that I need you to change. If you open your time templates and hover over up above, just find that. Okay, yes. Turn that off, Jim. Go below the one you were just on. Yeah, you can turn that on if you'd like yesterday. Click yesterday and turn off the one below once that loads. Go to the one below, yeah, and hover. Now click off today and yesterday on that one. Thanks. Will give us a better screen to look at everything.
Okay.
Are all these references, do they need to, yeah, they got the gap there. Okay, so those lines are all pretty relevant. Jim, a question that was asked earlier on crude, which is relevant to what you were just talking about in the S&Ps. On March, I can't remember the day, Kali, on March 18th in the market profile, the crude had a poor low. However, on the daily chart, it shows excess. How should we reconcile this?
I put more emphasis on the daily than on the bar chart.
Because make that larger, Jim. Because Kali, very quickly, you remember that the poor low in an instance like that can reflect that the market was getting too short. It's not always a bad thing. But go ahead, Jim. We're at the open.
Okay. No, incidentally, for crude, there's four poor lows on the crude on the rally, all the way from the bottom. And that's not uncommon because a market that was very short. And remember, a lot of times poor lows can come when a market's very short. Okay, so where are we right now? We've opened well above the cluster highs. The first thing we said, remember that not all traders place their stops in the overnight market. Matter of fact, a high percentage of traders do not have their stops in the overnight market. So the chances are very high that, what I was trying to say earlier, that there's a lot of shorts from Friday that still have to cover. And I think that's probably what you're seeing right now. Remember, a lot of traders do not place their stops in the overnight market. So those traders, when this market opened this morning, opened above this cluster highs, all these people that shorted late on Friday that didn't cover in the overnight market, they're in trouble. And I think that's what the market's dealing with right here.
Could you pull it down a little so we can see the overnight high, Jim? And also, the point here, too, is the overnight inventory is long. We're not seeing an adjustment counter auction back to adjust that inventory. So that's a bullish sign, which was one of the scenarios. We're at the edge of yesterday's range. We're breaking out of range. The question now is, are we going to hold or is it going to be a breakout failure? Clearly, with this kind of pressure on the market, you can feel the shorts are trapped. They may try and get that overnight high and see if there's acceptance outside of the overnight high range. So you got to take it one piece at a time. But I'm just trying to stay right here, Jim, with the, we opened at the edge of range or toward the edge of range.
The first thing you have to do, the market always has to handle current business first. Current business, what I was trying to indicate earlier, current business is more than likely the shorts from Friday. And like any business, current business is first. So the shorts right now, is this what I was trying to say earlier? They very few of them place their stops in the overnight market. So once we open today, there are all these late shorts. And look how far they took this market down on Friday. And the laggards didn't cover by the time we settled. There's a lot of hurt going on with a lot of short-term traders that got overexcited on Friday. Additionally, what you're dealing with is you had the month-end options expiration over the weekend, and now the traders that got exercised on Saturday, they have to deal and adjust their positions this morning that they got assigned on the weekend, and that can put a tremendous amount of pressure and havoc on this on the market this morning.
Okay. We want to mark the overnight high there, Jim, just so we have a visual, please. Go ahead.
No, go ahead.
No, the gap we measure from the high or low to the open, not the settle, which is a more conventional technical gap, Chris. Yes. So you got that.
Yeah. We do not have a gap this morning.
Is the fact that the overnight high is higher than the pit session high from Friday significant?
No, not to me it isn't. What is significant to me really took place on Friday. And what I thought was significant was the Friday, when the point of control did not go lower and these clustered high, I just thought we just got ridiculous shorts, dangerously short on Friday. And of course, then even the way it rallied back late in the day said there was a problem. And that problem continued, overnight. Now, it wasn't helped. We came into Friday and there was negative news on Greece. And of course, we come in today and these shorts are pressured even more. Over the weekend, China raised the reserve, lowered the reserve requirements for banks, which is, it's another form of stimulus, and we know the effects that's had on the market. So what you're dealing with this morning in the S&Ps, I think you're dealing with a tremendous amount of short covering as a result of people that got overly excited on the downside on Friday. You are dealing with assignments from the month-end option expiration on Friday that have to take care. They have to take care of their assignments today, and they probably got assigned the wrong way. So you're looking at short covering. I think you're looking at a lot of short covering this morning, and and that's what we were warned. And right now,
could you slide it down, Jim, so we can see the references coming up above and over to the right?
And usually when you see this many single prints, that's a sign of short covering. Just like the other day, we said the single prints coming down, the gap in the single prints were a sign of liquidation. Now you're probably seeing just the opposite this morning, and that is that's short covering. The single prints they're just annihilating these short-term traders in here. Mm-hmm. Overnight inventory was 100% long. The market did very little to adjust that inventory. That's a very positive thing for on a short-term basis. Okay, a couple of fast questions.
We have a comment that the ES breakdown on Friday was really resulting or influenced by the bonds and what was going on in the bonds. I don't know if you have any comment for that intermarket relationship.
I do not think that's the case. I mean, I may be wrong. I saw the breakdown in Friday as simply a market that had gotten far too long with traders laggard traders blindly going for the all-time highs. the market got very long. You got some negative news on Greece, and that started the liquidation. That's what I saw in the market. People may see other things. I didn't see other things. I basically saw a market was long. I was putting a lot of emphasis on Thursday's attempted direction. Thursday's attempted direction was up. Value was overlapping to lower. As Julia knows, because she saw my trade position the night before, I went home long Thursday night with puts, simply because I saw the market as weak and I saw inventory as very long. I was no consideration to the bonds or dollar or anything else at that time. I simply saw a lot of short inventory, and I saw a very weak market on Thursday.
A lot of long inventory.
A lot of long, late long laggard inventory.
Yes. Jim, do you want to make your profile just a little bigger, not overly, so we can see the volume data a little better and slide it up a little? Yeah, just there. We had a question. You said that it was only, short-term and day time frame liquidation from Friday. What would the market look like if there was new money in old business? What would it look like if there were new money?
But let's not talk about what it would look like. Let's talk what it wouldn't look like. That's why I showed you. You wouldn't see these clusters. You wouldn't see 5 periods trading within a couple of ticks of each other.
And then selling it weekly.
And then selling it off. You would see a more steady, more orderly decline. Everybody always wants to know what would it look like if it was the other. I'd much rather look and say what do I see was going on that day. And on that day, what I just saw that it was just liquidation and short-term emotional trading. Okay,
if
now,
I may interject, it would also, the profile would be elongating to the downside, would be one time framing lower. You wouldn't see it go really more than 5 or 6 wide because there would be this continual selling. You'd also see the volume increase, where the volume confirms that type of move because bigger money has bigger position size, so the volume would reflect their,
and you wouldn't see, Julia used the word elongation, you wouldn't see overly elongated. You were overly elongated on Friday, overly elongated on the top. Then you were thick in the middle, and then you were overly elongated down here. That's emotional trading. That is not what long-term money, and those know that have been around.
Slide it to the right. Sorry.
I ran an institutional trading desk, and you get more of a wave-like action. If I was selling large, as we call it, the official word for it is stuff. You sell, you let the market settle a little bit, you sell again. It's a more orderly process. Okay, let me go back to the S&P. The overnight, one of the things that we always stress is the overnight high and low are always good day time frame or short-term references. So we looked above the overnight high. Once we came back in, that is a legitimate place to try a short. Now, when you look at this pullback, the pullback right here, I believe, if anybody's watching, I think it went exactly to half back. When the market goes exactly to half back, did anybody see if it went exactly to half back? I think it did. That is usually, half back is a daytime frame reference, and it is usually not a lasting reference. There are traders that just blindly, automatically buy at half back, and it is not a sign of strength when I see that. Okay, so what we got a lot of chop going on. We've got a lot of single prints this morning, a lot of chop going on. I suspect an awful lot of shorts and an awful lot of adjustments from the weekend assignments from the month-end option expiration. It is not uncommon for me to stay out of a market the first hour or so following an expiration. On this market this morning, as you can see from what was written up, what I said, it's pretty comfortable that we were going to have short covering this morning, just because we were well above the cluster highs on Friday where all the shorts were.
And we had a report, it went 1 tick below half back. So we Yeah, but what we have a look above the overnight and fail, which when you have this many single prints and it's short covering, you'll often see it just gets to that reference and it takes a break. I mean, that is one of the scenarios, one trade we do. So.
And incidentally, I understand that, I don't know if everybody on the call this morning has been with us in the past. If you've been with us in the past, then it's a little easier when I talk as quickly as I have talked this morning. If you haven't been with us in the past, it's going to be a little hard to absorb all this information. This morning's impromptu webinar was intended for clients, was intended for people that have been purchasers of either the DVDs, have attended a webinar or a seminar.
Not webinar. An intensive or a Chicago seminar.
Yeah, Chicago seminar, or have been intensive clients. So they were intended for people that have been with us for some time. And I understand there's always some other people that get in. We are doing another intensive starting June 1st. That will be a 1-month intensive, goes from June 1st to July 2nd. As an added 5 weeks as an added bonus. Starting May 1st, I'm going to do a blog every day.
The chat, interday chat, real-time chat at the training site, and 2 daily reports, which is what you saw today. Is kind of an example of what will start May 1st. So
the live blog, the one-way chat will go out all day long during May and June. The intensive officially starts on June 1st. The other is a bonus for those that sign up early. Additionally, what you'll see is on the when Julia posts the intensive seminar schedule, that a lot of days there are 2 webinars. There's the one that I will do, and then Julia does a second intensive webinar for those that aren't as advanced, and so that we can keep the one I do more advanced, and then Julia can pick up a lot of the slack with the other webinar that she will do throughout that day. Last time we did an intensive was the first time that she did that, and her attendance was very, very high. I was getting a little jealous. All right, I'm gonna go back over. I'm going to take another look at, there's gold. I said gold has held the gap so far, and I'll take a fast look at crude. Julia brought up, she said, you look below the inside bar on Friday, and we said that was 56.85. This morning low is 56.81. I'm sorry, the low this morning is 56.79. The low on Friday, 56.85, 6 cents difference. So you have looked below that and you have started to rally. So you've stayed within the 2-day balance in there. Within the balance rules, stay within the 2-day balance, then you are looking for a rotation back up towards the upper end of the balance. Now, you don't know if you're going to get that. You have to watch it as the day goes on. Let's take a fast look at the profile. And so far, you also had a selling tail on crude on Friday.
A spike.
A spike. I'm sorry. You had a spike on Friday. You're above the spike. You've looked below the spike. You're above it.
It's a beautiful look below range and fail trade.
That's
another tight stop. Great opportunity.
Another classic trade. We call the
mark that low, Jim. Can you click that low, please, just so we can see the line? I'm just curious. What is it? 3 ticks? 2 ticks? You keep your crude in 3s.
Yep.
I guess, yeah. Close. You got to click it on the axis here.
No, I click on the axis, it goes away. I don't know.
Okay, it's just a little
This machine does a little different. Okay, so now the destination trade right now, the first one is going to be the prominent point of control from crude at the, I got to move the.
Why is the point of control green there? That it's below, it looks green below. That's obvious.
That's
Oh,
volume.
it's the volume put in
It's the
control.
volume.
Okay, I
Yeah,
see.
it's the
So
volume
the
put in
first is
control.
a conventional POC would be your first target. But that's a
Right.
beautiful example of what's your risk appetite? What's your trading style? Are you more aggressive? Do you want to take the inside bar failure, or do you want to see the 2-day balance failure? You know, it depends. It's definitely a really kosher trade to take it, look outside of the low and come back into range. That's a beautiful trade, but you never know if it's going to keep going down and take out the 2-day low.
It's almost a must trade. Once you look below a previous
Tight
day's low,
stop.
yes,
Yep.
I was looking. I mean, I'm looking at a bigger picture at the 2-day. But if you're a short-term trader,
Or a day
once you
trader,
look,
yep.
or a day trader, once you look at this trade, you look below and come back in. It is what we call an asymmetric opportunity. The risk is very limited. The risk is very limited. You look below this low, you come back in, you buy it, you put your stop right here. It's a very low-risk trade from a dollars and cents standpoint, and the potential is, of course, back up to the point of control, at least initially. Now, when we talked about this earlier, one of the things I said, I didn't go look at the profiles because to decide to do this trade always has a lot to do with context, too. When you look at the context of looking at the absolute profile, and you see that you have a very prominent point of control up here. At that point in time, that changes the context, and that makes it more likely that you will fail and start to trade back up. Again, context is everything. Okay, let me go back over to the, okay, so we look below, we went back to half back, and we said that's a good reference, and it wasn't this time. The market took off again above the overnight high. That is very common when you have shorts. When you have shorts in the market, they are looking for a place to cover their shorts. So I'm not terribly surprised that it came from the half-back level, because the prominent piece of information I was dealing with this morning was, and you saw it again, it was the stops above the clustered highs at the 2078 level. If you remember, I said it's very unlikely that they got covered in the overnight market. Some would have gotten covered in the overnight market, but it's very unlikely that a great percentage of them got covered. A lot of times traders just don't put their stops in the overnight market. So I think what you saw, even though it would half back, I consider it a weaker reference, but I think the shorts were still in there. They just are still getting squeezed on that market. So again, review before we sign off. I'll take a couple more questions, but the big thing on Friday was that this was more than likely liquidation, the clustered highs, the very prominent point of control, the late break, the return. It's an indication that this market was just dangerously short on Friday. And the people that got overly enthusiastic about being on the short side and thinking there was more to it than that are paying a fairly high price for that this morning. So we've filled the gap. We've got a very prominent point of control up from Thursday at the 2098.75 level. We also, don't forget, carry forward, you also have a very prominent point of control down here at the
From Friday.
From Friday at the 2075 level. Again, before we sign off, I want to go back to
Not from beginning, from current slide.
and remind you that this is now the 35th or 36th day in this absolutely nothing range. Volatility is high on a short-term basis. We're seeing that again today. However, overall, the market's gone, nowhere. Okay, let me take a couple final questions.
Can we go back to the window trader screen? We are using Window Trader. That's our market profile software. If you're interested to learn more about market profile platforms available at our site, we do have a listing of several, not all of them, but virtually all of them under Resources, Market Profile Platforms. Jim uses CQG and Window Trader. I use Window Trader. Okay. Who are these short-term day traders trading against that is constantly squeezing them out like this morning?
Okay, well, you have day traders.
Make that a little smaller, Jim, so we have a little more perspective, and slide it to the right so we can see some of the prior sessions. Just, yeah, thanks.
Day traders come in flat, they go home flat. Short-term traders they usually trade 3 to 5 days, maybe up to a little bit more, maybe 9 or 10 days. But they have huge pools of money. We break it down into basically 4 different categories. Day traders, short-term traders, intermediate term, and long-term. Intermediate and longer-term money are people that are in the market for extended periods of time. They may be in for months or years at a time.
Mostly long-only money managers, correct, Jim?
Mostly, yeah.
Long only.
Yeah.
And okay, go ahead.
No, go ahead.
No, I have some questions. You know.
Oh, okay. This is another question. Then let me finish what I'm saying. But these short-term traders have huge amounts of capital, sometimes up to $1 billion or more dollars, and they can make the markets very, very volatile in here. And I personally think that they act together. They are either that or they figure out what each one's doing, and they run the markets together on there. This morning, again, you're talking about shorts from the short-term traders, plus you're talking about, more than likely, traders that got exercised from the month-end expiration on Friday, got assigned on Friday, and they have to correct those positions this morning. Very difficult following a day like Friday and an expiration. And also, like I said, look at Friday. We are more than likely seeing a tremendous amount of short covering in here. There's too many single prints to suggest anything more than short covering. Okay, Julia, you had a couple more questions.
Yes, thank you, Jim. We are still having the webinar this afternoon at 4:30. Okay, I have a few questions on that. Secondly, is the intensive for newbies? The intensive is advanced. Okay, it may not be for you. However, if you do want to learn more, it is certainly a way where you can come into the intensive. We have the Q&A webinars after to help you. You have access immediately when you enroll to the member archive of the articles. Perhaps you've read Jim's 2 books. That helps. Or you can buy the Field of Vision DVDs. That gives you a nice framework and a solid foundation to come to the intensive more informed. So I don't want to tell you if it's right for you. We certainly do what we can to bring you up to speed, and when you come out the other side on July 2nd, you will be seeing the markets very differently with things that were invisible to you before. They'll be popping out at you. But it is an advanced course, and we don't want to keep you from coming to it, but we want the expectations to be understood. You can get the DVD program, and that'll help you get up to speed. Read the articles in the archive, watch the webinars in the archive. There's a ton of information for you when you do enroll, but you know, it depends your proficiency with the profile and what you're looking to do. You can always call me and we can talk about it. Okay.
One of the reasons that it's advanced is, one, because some people have been with us for some period of time, but secondly, what I've said very often, trading isn't like learning tennis, where you can go and you can play at different levels, etc. When you trade, you are trading against the pros from day one. There is no training field for this. And paper trade really doesn't do it. It just doesn't address the emotion. So if you're going to trade, you know, you're advanced from the first day you're dealing with nothing but advanced traders the first day you enter a trade. Okay, right. Thanks.
Yes, thanks, Jim. Yeah, it is like there's no regional practice courts here. We're going into the Olympics. The best people in the world are connected, and that's who our competitors are. So have no illusions. Okay, the week high-low information Jim has shared recently is unbelievably potent. This morning we had a perfect long opportunity when the early trade stopped right at Friday's high and sold off almost to the open. Perfect low-risk long with nice results. Okay, thank you, Mike. I thought that was a question, but thank you. Yeah, and the thing is, see how we looked above the overnight high, we came back in. You can do that trade, but once it doesn't continue lower, look what value is relative to Friday. If you can slide it up a little, Jim. You know, you've got to be respectful of the momentum and the pressure. So you fade it, which isn't exactly the smartest thing. It may be a wiser trade to be getting long on breaks, but the point is if you fade it and it comes back into the overnight range, which it did, got only to half back by over one tick. If that thing isn't showing continuation, look what you're fighting. There's some momentum here, so you would nix that trade immediately. You don't have to wait for it to stop you out 6 ticks below the overnight high or wherever your stop is, because you've got momentum and obviously strength there, and we're broken out of the pit session range. Okay, I just wanted to bring that up as we're in it. We got some big volume at the gap. A lot of traders stepping in there.
The big question today,
gap fill.
The biggest thing today in order to get you oriented for the day is not the little reference places. It's the review of Friday's break, review of the clusters, the discussion of the shorts, and the discussion that the shorts the high percentage of them do not get covered in the overnight market because they don't carry their stops overnight. The discussion that those shorts from Friday we're probably going to have to cover this morning. And then added to that was the expiration and the assignments on Friday. On Saturday morning. The assignments go out on Saturday. That those people that got assigned have to adjust their inventory this morning. Those were the big pieces of information. They're not the exact references and things like that. They're the bigger pieces of what is the market have to deal with today, and it has to deal with current business first. The current business were the shorts. The current business were the assignments from Saturday. And that's really what's going on. And when you see all these single prints this morning, that is more than likely a sign of short covering or old business rather than new business coming into the marketplace. Okay, let me say thank you for this morning. We'll say that if those that have been to prior intensives understand that there is a lot of very new information, particularly as it relates to short-term trading indicators that has really become clearer to me in the last 6 to 7 months than it has in my entire 10 years of trading. So there is new information, and it has been fairly important. But anyhow, thank you for taking the time this morning. We'll see some of you that want to be on tonight. We're going to talk about how do you prepare for the first hour of trade, and should you trade the first hour of trade. That's what we'll be doing after the close today. So once again, thank you very much, and we'll see a lot of you later this afternoon.
Okay, Jim, thank you very much. That was excellent. And, you know, Jim didn't have to do this, but he thought it would be a really great opportunity to share some thoughts and increase your learning. So thank you very much, Jim, for giving your time and taking away from your trading, because I know you would have been trading this morning. And thank you, everyone, for being here. It's fabulous to have you all here. Have a wonderful day. God be with you. And we'll see you back here at 4:30 if you choose to join us. This webinar will be posted very shortly at the jdaltontrading.com under resources, webinars, recorded webinars, okay? And that goes for all webinars. Okay, so thank you very much, everyone. Have a fabulous day. And thank you again, Jim. Bye-bye.